Hello and welcome to The Explainer. You know, a lot of us dream about building wealth, but then you look at what you have to start with and it can feel, well, pretty much impossible.
In fact, there's a common belief among many successful investors in Japan that the single hardest hurdle to clear is getting to your first 10 million yen. So why is that? What is it about that first mountain that makes it the toughest to climb?
It's a really fascinating question. And today, we're diving into insights from a whole bunch of Japanese investment experts who've laid out a clear, step-by-step system to break right through that wall. And guess what? It's not magic. Okay, so the first and honestly the most powerful part of the system is what we're going to call the snowball engine. And it's all about completely changing how you think about dividends. It's so tempting to chase a high dividend yield right now. But the real secret, the actual long-term wealth builder, is finding companies that consistently grow their dividends year in and year out. It really is like the difference between getting a single nice meal and planting a garden that gives you more and more food every single year. So this right here is the key metric, the dividend growth rate. You don't want to get too fixated on the yield a stock pays you today. The really critical question is, by what percentage is that payout going up each year? Because that is the fuel that makes your snowball bigger and faster.
And the impact of this growth is just staggering. There's a really simple financial shortcut. It's called the Rule of 72, and it illustrates this perfectly.
So if you've got a stock with a 10% annual dividend growth rate, your income from that investment is going to double in about 7 years. Not bad. But look what happens if you find one with 15% growth. Suddenly, it doubles in less than 5 years. That seemingly small difference shaves years off your journey.
Okay, so let's make this totally real. The source material gives this fantastic simulation using a well-known company, NTT. And look how simple the setup is. You start with a really small investment, just 16,000 yen. You assume the dividend grows at its normal historical rate, and then you just reinvest every dividend you get for 10 years. And this is crucial. You don't add another penny from your salary. This is pure compounding in action. So what happens after a decade of just letting that snowball roll? Your annual dividend yield based on that tiny initial investment becomes a massive 16.8%. You've basically created a high-yield income engine from almost nothing just by focusing on growth and being patient. All right, so that's the why. That's the engine. But that brings up the big question, right? How do you actually find these amazing companies? Well, that leads us straight to pillar 2, the smart stock filter. The Japanese investment books we looked at suggest a really simple 4-point checklist. It's like a health checkup for a stock. First, you want a decent starting yield, say above 4%. But more importantly, you want to see a 10-year history of sales and profits going up. Then, a clear history of them increasing the dividends. And finally, you check the payout ratio. You want a sustainable number, maybe between 30 and 50%, so the company has plenty of room to keep growing without getting stressed.
And if you're ever feeling a bit unsure where to start, the books offered this great little rule of thumb. Industry leaders usually have the most stable businesses and a real commitment to rewarding their shareholders.
So we have the engine and we have the filter to find the stocks. But there's a final, absolutely crucial pillar: mastering your own psychology so you can stay invested for the long haul.
This might sound a little harsh, but the data is so clear on this. The biggest threat to your growing wealth isn't a stock market crash. It's your own reaction to it. We all get scared when things drop and greedy when they rise. And that tricks us into making the classic mistake of buying high and selling low. I mean, just look at this. It's wild. If you stayed invested for 20 years, you did great. But if you panicked and missed just the 10 best days in the market over that entire time, you cut your potential returns almost in half. And the craziest part? Those best days often happen right after the absolute worst days, exactly when fear is at its peak and most people have already sold. And this really highlights that being busy is not the same thing as being effective. You could have a trader who's glued to the news for 2 hours a day, reacting to every little thing. And then you have an investor who just spends maybe an hour a month sticking to their plan. Well, after 30 years, Investor B often comes out way ahead. Sometimes, the most profitable thing you can do is nothing at all. The data from Japan's wealthiest investors also shows another key habit. They don't bet the farm on one idea.
I mean, it's overwhelming. Over 94% of those with more than 100 million yen own more than 5 stocks. And you can see most own way more than that. The principle is crystal clear. Diversification is your best friend.
And this is because they understand a really dangerous mental trap called survivor bias. We constantly hear those flashy stories about the one person who went all in on a single stock and became a millionaire. What we don't see are the thousands of others who tried the exact same thing and lost everything. Their stories just disappear. The wealthy investors know not to model their strategy on a lottery ticket.
So how do we put all of this together? It all comes down to taking that very first small step.
So let's recap the whole framework. It's a 3-part system. Pillar 1, you build your snowball engine with dividend growth. Pillar 2, you use the SMART filter to find quality companies. And Pillar 3, you master your own psychology to stay in the game for the long haul.
So the big takeaway is this: building wealth isn't some giant leap you have to take. It's a journey of consistent small steps, all guided by a smart and patient system. The only question left is, what small step will you take today to get your own snowball rolling?
Thank you so much for joining us for this explainer. We really hope it's given you a clear, confident path to get started. And we wish you the very best on your investment journey.
If you enjoyed this video, please give it a thumbs up, subscribe to the channel, and share it with your friends. Your support means the world and helps me keep creating more content.